You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
Welcome to Options Playbook Radio. I'm your host, Brian Overby, Ally Invest Senior Options Analyst and author of the Options Playbook. All right, we're going to trudge on through the end of the earnings season. Last week, we actually took a little pause and we went back and looked at Google after earnings. Actually, it was still news-based information, though. All the FANG stocks, well, Google is actually Alphabet, so you need to know that as far as a lot of the FANG stocks are concerned. So the Facebook brought down a lot of stocks. We talked about how it increased the volatility, and that's one of the reasons why we like to do butterflies around earnings, is because we like pumped up volatility, because it lowers the cost overall of all butterflies just in general. Higher vol usually means lower cost in butterflies. And so we looked at a skip strike butterfly last week, and we'll just cover it real quick, like what we did, and talk a little bit about what happened in that. Alphabet last week was trading at 12.32. We recorded Options Playbook Radio after the market closed on a Wednesday, which that is what we're doing right now. The market is currently closing, and it's Wednesday, August 8th. Well, last week it was August 1st, and we looked at Alphabet. It was trading at 1232.80. We went a little bit onto the bullish side. Actually, we had a skip strike butterfly, so it was neutral to bullish on the trade is the best way to say it, because we did it for a net credit. We bought the 1245 call, sold the 1250 call 2 times, and skipped the 1255 and bought the 1260. That made it the skip strike butterfly, or the modified butterfly, also known as. And we did this for a net credit if we got filled at the midpoint, which is always a big if, of 18 cents. And it always came with the disclaimer that it's just a paper trade. And as always on Options Playbook Radio, we're just trying to learn. We were trying to look at situations where a specific type of strategies might apply. And this trade was solid. We put the trade on. The market actually came back a little bit from the first. And ideally, we really, when we say neutral to bullish, we really are more neutral, especially when this trade is put on, because skip strike butterflies are fairly odd in that they start out and they're going to be, on the call side, they're actually delta negative to start. And as expiration approaches and your forecast becomes correct, if your forecast becomes correct, they will become delta positive. So it's a very odd trade. So ideally, your best scenario is that you put the trade on, you get it on for a decent price, and the market just slowly starts trudging up towards your strike price. And guess what Google did? Basically that same scenario. We put it on for about an 18-cent credit, which meant that if the market just stayed where it was at or continued down, in that scenario. You would walk away, all the options would expire worthless, and you could walk away with your 18-cent credit, less commissions, of course. But what Google did was the next day, the high for the day on the 2nd, the day after the trade, paper trade was talked about, went up to 1244, and that's just the very high. The low was 1218. On the 3rd, the high for the day was 1246, which means you really should have got out of that trade when it hit. Well, we weren't quite up to the high strike, but 1246. So it's trading fairly good with us. But I would think you would have got out of that trade after the long call started to get in the money. That should have been a profitable trade at that point in time, fairly profitable. And then the market never did get up to the 1250 strike, so there was never any real danger. And also, we weren't in danger of hitting a home run either, because it never came close to that. And the market eventually closed on Friday. The closing trade was 1237.67. So worst case scenario, you just put it on, you forgot about it, let it ride, and you ended up making your 18-cent credit when it was all said and done. So that was a fairly simple trade to put on. And one of the things that was nice about this skip strike butterfly is we had volatility come into the marketplace, not because of an earnings or because some major news was happening, but just in general, all the stocks in this sector got very volatile, and that drove up the volatility in Alphabet. So that was the trade. We'll move on today to another volatile stock, but this one we're going to do around earnings. Right now, the stock that we're going to talk about is Booking Holdings Incorporated. It's actually BKNG is a symbol. BK as in kite, N as in Nancy, G as in George. That used to be Priceline. The symbol has changed. The company name has changed, but it's Booking Holdings Incorporated. And the last trade right now, we're taping once again on August 8th. They're about ready to announce earnings. And the last trade was around $2,045. And once again, we're talking about a high price underlying that has a lot of volatility in the underlying. And this is when it's interesting to do butterflies. So I'm going to look at a butterfly, but I'm going to mention that the underlying stock is down about $33 at this time. And because of that, that makes me a little nervous because that's a pretty big move to the downside just in general. It's on a percentage basis, it's about 1.5%, right? 0.5% on the downside. But you're going into an earnings announcement and you get that much of a move to the downside. I think I want to jump on and piggyback to that. And once again, this isn't meant to be a recommendation, but I'm going to go to the downside. And a lot of times when we were looking at the skip strike butterflies, we always talked about doing them to the upside for a couple of reasons. Is you do have risk if it moves more than a one standard deviation move. If it gaps open a huge amount, that's where all your risk is. And on the upside, stocks have a tendency to go up a little slower than they do to the downside. On the downside, they go down a little faster and sometimes a little farther. So I don't necessarily like to do the skip strikes on the downside. You can do them. They're not bad. But if I want to be bearish on a big stock that is already down 33 points on the day or 1.5% before they announce earnings, I'm going to look at just doing a regular butterfly. And the main reason why is that my risk will now be limited to what the net debit is that I paid for it. So on the regular butterfly, I'm still going to stay in the shortest term expiration, and I'm still just speculating on earnings. But I need to know what the expected move is. And if I look at, let's call the stock 1245. We look at the 1245 call and the 1245 put, and we'll take about a midpoint. We're talking about maybe 110 points is about what it's looking at. So I'm going to try to put my short strike around 110 points down from where the market is at right now, because that's the expected move. That's a possible move in order on this underlying. And it's Wednesday. We have 2 days for this underlying to trade. I would prefer, and I mentioned this when we talked about Amazon, I'd prefer to be doing this trade on Friday. So you just have basically 1 day and all this premium that's in this $2,000 some odd stock with implied volatilities around 75% on the at-the-money option contracts. I would much rather go out and do this trade with only 1 day remaining of trading. I want if I'm correct on my forecast, I want my short option contracts to go away as soon as possible. All right. So We're going to go about 100 points down, market at 1245. So that would be about 1945 2045. So it'd be about 1945 on the downside. So I think that's a good number. Let's keep that as our center strike. We're going to sell 2 of those, and then we're going to buy the wings. And I looked at doing from inside the Ally Invest platform. I thought about a 10-point wide strike, but it's really about your risk tolerance, because this is really just a shot in the dark. I would just as soon go wider if I could. The 10-point wide butterfly, which means I sell 2 of the 1945 with the August 10th expiration, buy 1 of the 1955 on the upside, and buy 1 of the 1935 on the downside. So we just have a 10-point wide butterfly. It's a very cheap butterfly, but you're only talking about a 20-point range that you need this underlying to be in at. That was trading for about 30 cents. So you get 10 points of upside, you pay 30 cents for it. I actually like the fact, and this is a little bit more feasible on the downside than the upside because of the way volatility skews are around earnings. Butterflies are cheaper on the put side a lot of times than they are on the call side. So if we went out and we looked at that butterfly on the downside and we went 20 points wide, which we can do that because it's a $2,000 some odd stock and it's still going to be fairly cheap. So the official paper trade for the week is to do out of the money butterfly around earnings on Booking Holdings, which is the old Priceline. And we're going to use the nearest expiration, which is August 10th. Today, the markets are closing and it's August 8th. And we're going to buy the 1925 strike put, sell 2 of the 1945 strike puts, and buy 1 of the 1965 strike put. The midpoint on this trade is 85 cents. If we can fill anywhere close to that, that would be our maximum risk. So for every 1 by 2 by 1 butterfly, we're going to pay $85 for that trade. We are around what the expected move is at. The expected move is somewhere between 105, 110. We're about 100 points away, so we think it's feasible to get to this middle strike. And our range, even if it stays within, we got a 20-point range because we've got a 20-point wide butterfly that we would like this underlying stock to stay in, and then we should do fairly well on that trade if it does happen. So our maximum upside would be 20 points minus the net debit of 85 cents, which would be $19.15 on that trade. And if you ever made a 100% maximum gain on a butterfly, you usually deserve the stupid award for doing that because you should have got out of the trade beforehand. You should never ride it all the way to expiration and hope it pegs right on the strike price, because that's the only way that you're going to get the maximum that a butterfly is worth. At any point in time over the next 2 days, if it ever trades at 1945, the middle strike, we're just going to get out. We're going to sell or buy to close everything. And we'd be buying to close 2 of the center, selling to close the wings. And we would be getting out of the trade for whatever profit we could get at that point in time. You just want to get out when it hits that strike. And if we're dead wrong and the market goes straight up, even though it's already down $33 actually on the day, if it did go the other way, the maximum loss we could have is that 85 cents, that net debit that we paid for it. And that would mean for every 1 by 2 by 1 butterfly, we'd lose $85 plus commission. So want to emphasize this is just meant to be a paper trade. But why are we doing a butterfly instead of a skip strike butterfly? I think that is really the message here, because we wanted to be bearish. The market is very bearish going into this earnings, having a 1.5% down day before their earnings even gets announced. And because of that, we didn't like the risk, the additional risk of skipping a strike in a butterfly and adding a credit spread to help pay for it, because that adds additional risk to the overall trade. So we're just going to do something in a high price stock, and it's going to be a low dollar amount to get in, and it's going to be limited and known risk. And that risk is going to be that net debit paid. So that's it for this episode of Options Playbook Radio. If you have a topic you'd like us to discuss on the show or a question you'd like us to answer on the program, you can send them directly to me at theoptionsguy@invest.ally.com. That's theoptionsguy@invest.ally.com. Thanks for listening. We'll be back at the same time, same place next week. Until then, may all the options you bought finish in the money and all the ones you sold finish out.
The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA and SIPC.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.